Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It's Macro Monday. Let's take a look at the bloodbath that's going on out there. Bad things happen below the cloud, and that's where we are at. We're living it. We're feeling it. Tesla, chief among them, minus almost 16% today. Huge move. MSTR down big. BTC obviously down. Alts down more. But we will start with the flows report from James at CoinShares minus 876 last week. 750-ish of that was just the US stuff on the BTC side. We did have some flows in Solana, Ripple, SWI, multi-asset, but for the most part, United States again leading the pack here, up and down, a little bit out of ETH as well last week. On the 30-day cumulative flows for BTC, we are seeing some negative action here. Finally, there's always a risk when you have euphoria. You're going to have the pendulum, you're going to have the rubber band swing the other way. And that's where we are at now. So this is the largest outflow for the ETFs on a 30-day basis, or just any products globally, I think ever at this point, even more than 2022, actually. A lot of that is basis trade. Keep in mind, not all of that is a net long position. But if we contrast that with gold, which I think had its highest week of flows ever on record last week, maybe not in ounces, but maybe in US dollars. Looks like based on this reporting, it has been higher in the past, but the previous charts that I saw, it was something like 4 billion in a week. Either way, monster flows for gold. Gold down today. We'll talk about it a little bit, but not much relative to the rest of the market, obviously. Gold got caught up in that momentum trade as well with the tariff panic and gold being shipped back to the US, and that has certainly helped keep it up, whereas all of the other momentum stuff has rolled over significantly at this point to the tune of 50%. I mean, Robinhood's down 20% on the day today. It's a lot of stuff pulling back significantly. Here's a look at the CME basis and open interest. We're basically close-ish to being back to the open interest of November 5th. This hasn't updated yet for today, but I imagine the notional value of open interest is going to be down. If we look in coins, we're certainly down past the November level. And the basis still quite low for BTC, even though it's higher than you'd see on most other things. But again, this hasn't updated for today just yet. And looking at the charts, CME futures had a premium for a minute, but I think that's also collapsed. This is on the legacy cloud, 1852, 104.26. And the first bearish warning is always the TK cross. That's the first exit signal that should not be ignored after a long period and a big move like that. The next signal is a close inside of the cloud, which again should not be ignored, especially if you're sitting in a zone for multiple months. And now we are below the cloud and we are in bearish territory. So this could be a low, this could be bottom, right? Et cetera, et cetera, et cetera. It could pattern out like it did over multiple months in mid-2024. Orange Man could come out and say something regarding the markets, even though that's probably not going to happen. The Fed's probably not going to say anything productive on the 19th. They may end QT, but I don't think that's enough to reverse markets. We've got CPI this week. Probably comes in at or under expectations. That's probably not enough to save this market here either. So in the very nearest of terms, I don't know what we have to save us. We'll take a look at the CME futures probabilities for rates, but we could see a 50 cut in May, not because the markets are melting, just because, as we'll take a look here on Truflation and other inflation estimators, we're getting in the wheelhouse of potentially bringing rates down, and if unemployment rises, that would give the Fed justification, I think, to bring rates down. So that means on this chart, it's a lot of airtime here until May. We may have forward guidance before that in April, but the Fed doesn't meet in April. So the way this is looking, not great. Here's IBIT. Again, same deal. Bearish TK cross in the cloud, through the cloud, below the cloud. What I'd want to see on these charts, I'd want to see this div form and hold. I'd want to see a low hold. I'd want to see either a double bottom, a triple bottom, an Adam and Eve, an inverted head and shoulders, something on lower time frames first to give us a chance. But the reality is this probably is going to take a multi-month recovery to turn this bus around. There's a gap here at lower 40s and then even lower pre-election. It's hard to see there, but it's down there at probably 38, 39. But 42 on IBIT would be a full election retrace. MSTR continues to struggle, continues to get smacked down in this range. It does have a div that it is working on, higher low and RSI, potentially lower low in price. That alone is not enough to save it, but it's a sign again that we're getting some capitulation on the bearish side. For the bearish side, bearish exhaustion, whatever, bullish capitulation, you know what I mean. But nowhere near bullish territory at all. WGMI is another one, has all the footprints, the fingerprints of retail capitulation. When you see this sort of parabolic move to the downside, we see this in Alts a lot. We saw this in Tesla in 2022. We see it in BTC. Is it a screaming buy here? No, but it is forming a div with a significant lower low and a higher low in RSI. I would love to see this close a dragonfly and hold that low for a couple 4-hour periods. But there's been a complete unwind in the miners. And then again, on the leverage side, BITU down significantly today, I think down 20%. Not quite a daily div, but on the 4-hour, there is a div here. But again, it's in bearish territory. So all of this to the long side is contra trend. It is playing with fire a little bit. But at some point, this stuff starts to look bad enough to buy. Are we there yet? I think it's a little early. As bad as the legacy markets are melting down, it really isn't, in the grand scheme of things, that bad. It's just been straight down, right? And it's been amplifying over a couple weeks here. So what else I would look for is I would look to see if BTC can bounce outside of legacy hours and then hold those levels into legacy open. Because for the most part, we've just been pulled down on macro stuff. Even Sunday before futures opened, we were down significantly from 86 to 80. So we haven't been able to hold much of anything just yet. Before I go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro at the link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Paired Ventures, Inc., PBI, DBA, and Kraken. Looking at the BTC, we do have a div here on the daily. If we pop on the line chart to make it more obvious, RSI is calculated based on the close of the period. So you do not want to use wicks when you're looking at RSI and divs. You're getting a lower low, significant lower low here with a higher low in RSI. Now, is this enough to turn the bus around and push everything back to 100K? No, but it is a good sign that we're starting to see some bearish exhaustion here. We're getting closer to that midpoint on the pitchfork. This is a process. This is probably not going to be a V bottom unless there's some sort of intervention by the Fed or the president, and I doubt any of that's going to happen, or the Treasury Secretary, whatever. Doubtful that any of that happens. Like I said last night, we're at the yearly pivot at 80. It would be great to hold that. To bottom out here over the next couple weeks would be totally fine, totally recoverable. We are also in the wheelhouse of the double top expectation of the breakdown, which is like 76 to 81. So we're in the wheelhouse there for what you'd expect to see on a move lower. The big issue again, though, is the cloud. We are not bullish on trend. We've closed outside of the cloud yesterday for the first time since September 2024. And now we are in bullish territory. So now it's up to the bulls to figure out if they can create a recovery, a bottom, despite legacy melting down. And across the board, the list here, there's really no place to hide on the crypto side. Oddly enough, though, a lot of these meme coins like SHIB, green on the day, I can't really explain that. Peanut, green on the day. I have no idea what's going on there. All I can think is that those have just been so rinsed already. Like they are already down. SHIBs or Pepe already down 80%. Like these can keep going down another 80%. But at some point, you just run out of sellers. At some point, ETH definitively broke 2K. Sol definitively broke 120. Div there as well on Sol. There's probably a div on ETH. Div on ETH, yes. None of these are confirmed just yet. What you want to see is the low holding. But again, it's a good sign that we're not seeing continuation in momentum. And this is looking a little stretched on oscillators. But this so far has been quite the move. And if we look at even ETH, that's similar footprint of just the parabolic puke, right? You see it a lot with retail trading, high leverage, that sort of thing. Can we consolidate? Can we hold some lows? Can this RSI div hold on these charts across the board? We'll see. We'll see. It's going to need some time. It's going to need lots of time. My confidence right now is low that any of this stuff holds, and it strengthens throughout the week. If we can hold into next week, what happens with CPI this week? We have PPI this week. I think this is Jolt's job openings, and then of course Powell on the 19th. We will see how markets react to that in the press conference. Again, another probably pretty important press conference. If he comes out and says everything's fine, there's no issues here, and doesn't end QT, then I can't imagine the markets are going to be happy with that. So if you're in that camp, you are probably already full treasuries or full cash or whatever. Now, I can't imagine CPI is going to be hot, as we'll take a look. It's been falling pretty significantly. But again, if CPI comes out hot above 2.9, I think the forecast on Nowcast is around 2.83. If it is above 2.9, markets will not be happy. That's 8:30 EST Wednesday. And as far as the Fed's concerned, they're not going to cut this meeting. There's not enough data really to support that yet. They don't really care about the markets at the end of the day, even though they do. It certainly isn't bad enough for them to take action. And again, you'll notice there's no 4 here. There's no April meeting. So the next opportunity for them to cut would be 5.7. Based on the data, unemployment data may spike at the end of the month because we finally have the Doge cuts baked in there. But this is pretty close to 50-50. We'll see. We'll see. And I'm in this camp. I'm in the potentially jumbo cut camp if things start to get bad enough with the numbers, if things look good enough with CPI, bad enough with unemployment. Then we could see that, because then the Fed could feel like they're behind if they didn't meet in April. But that's a long ways away. Here's Truflation, continues to sit sub 2%. I know some people have feelings about Truflation one way or the other, but it's not just Truflation that is getting crushed. If we look at the Fed's own projections for CPI 10 days into March, 247. This is the CPI print from Fed Nowcast, 283. And maybe more importantly, the PCE for this month is almost back to 2%. If we look at another estimation from Goldman for core, we are back down on their estimates to 2%, and we're making lows on core. That's core PCE relative to core. So we're making progress. We're getting there. The last mile, as they say. Some of the individual components continue to decline. Gas prices, 311, multi-year lows here on what people are paying at the pump. Oil, this is the low time frame 4 hour, but oil has been bearish on the 4 hour since January. So it's not just crypto, it's not just the indices. There's been a lot of bearishness across the board, and I wouldn't exactly call oil a momentum trade based on where it's been. But this has been coming down on growth concerns, probably. Manheim Used Vehicle Index. It'll be very interesting to see what this looks like throughout the year if the tariffs do take place, because that may work its way into used car prices. Not seeing that yet. We're down from highs of post-COVID. We're not back to the pre-COVID trend just yet, but we're getting there. But it's good to see that coming down. Lots of stories about credit cards and car payments and debt on a consumer level. People just not keeping up. And this is a new all-time high by the looks of it, of subprime delinquencies on car payments. Now that's Main Street. That's not Wall Street, but Main Street is definitely hurting. Another component for food prices would be fertilizer of inflation. And this has continued to slowly tick higher. So it's not going to help bring inflation lower, but it's certainly not where it was post-COVID. On the liquidity front, reverse repo still holds 129 billion. We'll see what it looks like at the end of the day today, if that comes down at all. But this represents an inert pile of cash used for liquidity. And there is some idea here that if this goes to zero, then the Fed will have to cut their QT program because liquidity will just be too tight to do so. We're not quite there yet on reverse repo. Still positive, obviously. But when this starts to get drained completely, then you may start to see additional liquidity concerns. For the GDP, we are in negative territory on the way they calculate GDP. Now it's going to take 2 negative quarters consecutively, along with other stuff for an NBER declared recession that's going to be backwards looking. It's not going to predict anything. So we're not quite there yet, but we're getting there. We're getting there. There was a thread Friday about GDP now from the Atlanta Fed. And what this all boiled down to was using a gold adjusted model, it's about at 0.4% rather than the negative 2.4, 2.8, whatever it was. So if you pull gold out of the import-export equation, it's not negative yet, but it is certainly not as positive. It's not at 2% as it has been. So this would help explain the number, but it's still not a great number, even at 0.4%. And this is a look again at the gold stuff. Tons of gold imports into the US, 30 billion USD in January. So that is real, and that is what you're seeing in the GDP numbers. Gold itself, the chart, starting to roll over a little bit. Obviously not down 25% from highs like everything else, but on trend here, it is weakening, definitely, on low time frames. Now I can continue to hold these levels. It's not a screaming sell, but on the 4 hour, it's certainly losing momentum. And once again, great trade. You don't always get multi-week moves, especially on gold, but that's why I tend to take these signals seriously when the setup presents itself so that you can be there along for the ride. This is the 10-year yield, down slightly today, still at around 4.25, probably not as low as the administration wants it to be. They probably want it closer to 3.5. So that's going to take some additional movements if they're trying to manufacture some recession or growth scare to get people to buy the 10-year yield, to bring the rates down, to term out the debt, whatever, right? If they're trying to do that, they're going to have to keep going. So we're not quite there yet on the 10-year as well. Looking at the 10-2 curve, this continues to slowly try to tick higher. And we'll see what cracks first. Jobs, rates, GDP. It's all just this toxic soup of uncertainty that's going on right now. But based on the 10-2 on inversion, we are due for a recession eventually within the next 4 years, I'd imagine. It's just hard to time that exactly based on this indicator. Look at the bond complex 3 ETFs. These look good still. You know, they're not screaming bullish. Shy probably looks the best among them here. 1 to 3 year ETF. Ag still looks fine. TLT kind of hanging out down there. Not great, but again, it's not down 25% from highs, and IEF somewhere in the middle, but Shy getting back above the cloud there. Bullish cloud. Not quite a bullish TK cross, but it's certainly another place to hide out other than money markets or short-term treasuries is to start to go longer out on the curve to see what you can get. Most likely, if the BTC lows hold at some point, you're going to get better value trading that. Now you're going to eat drawdown and volatility, but that's par for the course. It just depends how careful you want to get, right? Do you want to buy Shy here, or do you want to start dollar cost averaging into BTC? That's obviously up to you. But as people are looking for shields against what's going on, you know, that's one place they go, certainly. And if we look at year-to-date moves for US versus the world, this was as of 3/9. This is down even more on the NASDAQ. But Poland plus 30 on the year. Wild. Germany, China, Colombia, Brazil, Korea, Italy, all positive with money, what looks to be going overseas from US markets. So not a lot of love for the Mag 7 at this point. Fundstrat put together a Trump 2.0 versus 1.0 look at markets. And as bad as the S&P and the Qs are doing, the Russell 2000, the Russell 3000 are doing horrifically awful. Dollar index following along with Trump 1.0, gold stronger, Germany DAX stronger, China composite index there about the same. Bitcoin also down on a relative basis compared to Trump 1.0. So there's definitely some pain, and everybody knows that at this point. Is it just seasonality? Is what a lot of people are wondering. Is this a March effect where we tend to see weakness in the S&P? And we can slice this and dice this as the seasonality crowd loves to do and look at what type of year is it relative to the president. And we are following along with that pink line. So if we can find a bottom, if we can recover, the seasonality looks better into Q2, absolutely. and then drops off again in June to October, and then we get a Q4 rally. It's something to think about. I don't think it's enough to save anybody, but that's the seasonality relative to where we are now. Certainly within the wheelhouse to bottom in March. There's also this, looking at the VIX versus S&P seasonality. We tend to have the highest VIX spikes in March. So is that enough? Is that enough to bottom? I don't know. It's obviously way too early to tell, but if we were having some out of season spike, it would be easier to panic probably. Whereas seeing the spike that we're seeing now in the VIX is par for the course. It's what we see in Q1 and then settle down in Q2, settle down again in Q4. This is why historically crypto does better in Q2 and Q4. Alts do better mostly in Q2 and Q4 because that's when legacy markets tend to do better in Q2 and Q4. Bespoke Invest has been out here doing yeoman's work on forward performance charts. You know it's bad out there when people are calculating the forward performance of XYZ event, but what they did is they looked at gaps down of 1% followed by another 1% move down, and all of them historically over the last 15 years have been green 3 months later. Most of these, oddly enough, aren't really in Q1 that I can see. But if we're looking for good omens, that's a good omen. And just to put it into perspective, NASDAQ 100 during the 2020 COVID crash versus now is about the same, which is wild to think. Like, we're not quite there in this period of time, but we're getting there. We're certainly getting there. Looking at the SPY has really struggled to hold any level on the way down here through the cloud now. And it's the same story. Too early to tell. Is there a div on this? Probably at some point here. But this is going to take a process. The last time we V-bottomed was the yen carry trade stuff in August 2024. I don't think the expectations are the same here unless, again, the Fed intervenes, the Treasury intervenes, or the president says something, which is unlikely to happen. So that's going to take some time. Q's, same deal. Yen carry trade stuff there. And this is going to take some time to recover. It is not bullish. We had a dragonfly close-ish on Friday, and we came in with a gap down, selling it lower. So unable to hold anything at the lows around 500. Just not bullish. It's not bullish on trend. Not yet. This is IWM on the weekly. Haven't looked at this one in a while, but as bearish as everything else is, small caps are horrendously bearish. This is back to like almost the 2024 open. Pretty decent case for a head and shoulders breakdown up there as well. SMH on the weekly, you're getting a bearish TK cross price in the cloud on the weekly. Not someplace you want to live in the near term when you're getting that signal on the weekly. Much like BTC, you're getting plenty of warning signals up here on SMH, and it's still up over a 2x from the 2023 breakout. IGV also just completely rolling over very quickly, very bearish. Never really saw the continuation that SMH did. I wonder if some of the Doge software licenses that are being cut are part of this, like baking in the expectations that a lot of these companies aren't going to be milking off the government anymore like they were before. That's probably partially what this is. But again, Friday we had the dragonfly, even better dragonfly here, and it did not hold. We gapped it down. Just always important to keep in mind, you want to wait for the next day's candle. If you look at the August low, followed by the next candle, the June low, followed by the next candle. Even in February, dragonfly, next candle was higher. So to confirm the low, we would have needed a higher close today, and we did not see that, obviously, for IGV. Apple, just to point this one out specifically, has held its bearish TK cross since January, effectively. Now, it did flirt with a breakout. It did flirt with some cloud stuff here, but the cloud is scarily accurate most of the time. And yes, it will chop you up from time to time. Yes, it will pull you in on false entries. But this did a pretty good job here on the daily of not giving you the bullish cloud, not giving you the bullish TK cross, and much like everything else, back below the cloud here. So not a great look for Apple, one of the biggest companies in the world. And then finally with Tesla down, let's just double check. Looks to be closing the day down around 16%. The worst day since September 2020 for Tesla. So as bad as it is in the digital asset land, in the meat space, it is not a fun, happy time either. And until we settle down on the S&P, on the NASDAQ, it's going to be very hard for crypto to bottom. Not impossible, but it's going to be hard. And crypto could lead us out of this. It led us into this, certainly. And I'd love to see a close this week above 80. I would love to see something on the 4-hour that looks bottoming, but we're just not quite there yet. And this is going to take some time to confirm, because anytime we try to make a move higher here on the crypto side, legacy comes in and makes new lows, then we get dragged down, and thus continues the cycle to the core. So that's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.